Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record a video per week, so make sure you ring the notification bell to get notified each time one comes out. Over the years of buying stock, I came across various tips, hacks, and strategies for investing, so I brainstormed a list of these. Feel free to add some of your favorites in the comments. The first one would be dollar cost average in. This generally works best in a commission-free brokerage. So this is a common strategy during the accumulation phase. It's actually a series of small lump sums, which is fine. As you make the money, you invest it. True dollar cost averaging is when you have the money in a large amount, but you sit on the cash and you put it in slowly because you expect the market to go down. You're basically timing the market and it's extremely difficult. So whenever I have cash, I typically put it in. Lump sums win most of the time. This is versus the true dollar cost averaging because we are assuming we have an uptrending market. So if you have the money to put it in over time, you make smaller profits. The next strategy is dogs of the Dow. The dogs of the Dow refers to a stock picking strategy that uses the 10 highest dividend yielding stocks from the Dow Jones Industrial Average, DJIA, each year. You can, of course, use an index of your choice. You buy those 10 on January the 1st, you collect the high dividends throughout the year, you hope that some of them will turn the ship around and the share prices will go up, and then you sell all 10 on December 31st, hopefully for a profit. The results are actually positive, outperforming the Dow Jones Industrial Index itself and the index of the 30 companies by a couple of percentage points per year. The Dogs of the Dow strategy as a long-term investment strategy was popularized by an American money manager and author, Michael B. O'Higgins, in 1991. The next strategy is tax loss selling in a non-registered account. So this is harvesting capital losses as a tax write-off against capital gains either this year or 3 years going back, or you can carry that credit into the future. You're taking advantage of the stock going down. If you believe the stock will go up, buy a similar product now or the same thing in 30 days. If you believe the stock will go down, definitely sell it and harvest the loss. Don't hold on to a loser so you don't feel bad about yourself and your decision. Take the loss, put the money to work where it will go up, and get the tax benefit now. Use limit orders. This is a must for low volume traded stocks or to set up purchases. You can set up limit orders in your brokerage specifying the most you're willing to pay for a buy or the least you will take for a sale. This is so you don't get any surprises, especially with thinly traded stocks where you can buy some of the stock for $10, but not your whole order. The rest of your order is then available at $12 and $14, which is much more than you wanted to pay. And if you do a market order, you are going to pay 10 and then 12 for the rest and then 14 for the remainder. You can also set up limit orders to buy below the current price because that's what you want to pay. And then you can leave them for up to 90 days in certain brokerages. And the brokerage will automatically make the buy if the stock reaches the price. The automation may make things easier for you. Beware of value traps. These are stocks that have a low price to earnings and a low price to book ratios. And also beware of overpriced stocks, which have a high price to earnings with the expectation of future profits. So first of all, the value traps. Value traps are investments that are trading at such low levels and present as buying opportunities for investors, but are actually misleading. For a value trap, the low price is often accompanied by extended periods of low multiples, as I've mentioned. You have to differentiate stocks that are cheap for a good reason from those that have a temporary issue. You can spot the temporary problems by seeing if the company has a plan to get out of trouble, the industry or the world has started to change to make the company more viable, etc. The second one is to avoid wildly overpriced stocks with high price to earnings ratios, let's say in the 60s or higher, or no price to earnings at all, where the company makes no profits and its share price is so high because of expectations of the amazing things it will do in 1, 5, or 10 years, hopefully, because it is the next big thing. And we see 3 to 4 next big things per year. Diversify your investments. They say diversification is the only free lunch in investing. So diversify across sectors, across geographies, and across asset types, meaning stocks, bonds, commodities, real estate, etc. As you can see from this asset class return ranked from highest to lowest from 2008 through 2022, and feel free to pause the video, a different type of asset is the best every year, and frequently what has performed great one year is near the bottom the next year. Trying to time getting in and out of these asset types will typically have you chasing last year's winners and underperforming. So diversify by buying a little of each. So buying the index is a good way to go, and just keep buying. And you don't have to worry about what will do well this year, since everyone gets it wrong anyway. The next suggestion is to avoid hot stock tips. This is when the coworker at the water cooler says, I have a great stock for you. They define a great stock as something that's already doubled or tripled for them to become hot in their eyes. And your friend or coworker is basically just bragging about his or her luck, presented as skill at this point. What you want is low price, beaten up, but up and coming stock tips. That's what you're looking for. Buy wide moat companies. A moat is a competitive advantage over competitors, or preventing competitor entry to produce higher returns. It's just like a moat around the castle, keeping out the other guys. So a company with an economic moat is able to keep competitors at bay for an extended period of time. One of the keys to finding superior long-term investments is buying companies that will be able to stay one step ahead of their rivals. And it's this characteristic, think of this as strength and durability of a firm's competitive advantage, that determines the moat. A moat can be processes that can't be duplicated, something that lets the company hold on to their clients and customers, such as high switching costs, a brand name like Coca-Cola that lets the company sell sugar water at a high price while the no-name brands are at half that price. A near monopoly like Google has for search, or Microsoft for operating systems, or a political barrier like oil pipelines, or just a huge cost of constructing competitive railroads across the continent, or a 20-year development life cycle for a new company that will create microchips. These companies, through a lack of competition, can mark up their prices and have high profit margins and high profits. Please let me know if you have any stock tips you'd like to share in the comments. I could include them in a future video if there's enough of them. If you have any requests on what you'd like me to cover in future videos, please put that in the comments section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.